Hello, and thank you for being here in my channel today. My name is Felix Ortiz Rivera, and I'm the owner of Fidelis Lending LLC, and we are a mortgage brokerage that specializes in property finance for home purchasing as well as refinancing of property loan. I also specialize in HELOC, and we're going to talk about a little bit about HELOCs today, as well as I'm a licensed mortgage loan originator for the state of Florida. And in other words, I am the owner and I am also the loan originator here at my brokerage. So I'll be the person to talk to here. Okay, so let's jump into a brief explanation of the HELOCs because lately I've been helping a lot of clients with the HELOC refinancing instead of a regular refinance that takes advantage of the rise in equity value of their homes without having to refinance the existing mortgage loan. So here we have what HELOC stands for, which is a home equity line of credit. It's a line of credit that uses the equity that you have in your home as collateral for a loan without refinancing your existing loan. The amount of credit available to you is dependent on the equity in your home, your credit score, and your debt to income ratio. Okay. Because HELOCs are secured by the asset of your home, they tend to have higher credit limits, so you can borrow more money, and much better interest rate than credit cards or a personal loan. While HELOCs usually have variable interest rate, the one that I'm going to be explaining, or the ones that I will be explaining today, are with fixed interest rate. Okay, so home equity line of credit, again, HELOCs, are based on the amount of equity you have in your home. And to calculate the equity that you have in your home, you would just take the estimated value of your home less the total balance of your existing mortgage. Okay. Most well-qualified borrowers are able to take out up to 85% of the equity they have in their home. And that's, for example, someone with good credit score and a debt to income ratio that is within the guideline can go up to 90% of their equity for a HELOC loan. So HELOC rates vary and generally significantly lower than interest rates for a credit card or personal loan, which I've seen right now up to 26% for a personal loan, but slightly higher than your regular mortgage rate or interest rate for your regular original mortgage. HELOCs rates are usually variable, and we've talked about that, but again, we're going to use the fixed interest rate for the ones that I'm going to be explaining. Also, HELOCs tend to have very low origination fees, so it's a good thing to do, which, you know, when we do a refinancing, the closing costs are usually pretty high there, or not high, but they're just going to be a lot higher than in a HELOC versus a regular refinancing. So when you hear the term piggyback, there's what we call the standalone and piggyback HELOCs that is made at the same time. The piggyback is only used at the same time you use your main mortgage, usually when you purchase a home. And this is the purpose to allow borrowers with low down payment savings to borrow additional money in order to qualify for a main mortgage. You can get up to 90%. Without then the PMI, you won't have to pay mortgage insurance, because if you borrow only 80% on your main loan, then you're qualified not to have the PMI. Okay, as standalone mortgage, you can use it at any time other than at the same time as your original loan. So this is the one we've been using a lot lately, because of the reason that the rise in equity and people need to use a cash out and they don't want to refinance your whole mortgage when interest rates are at 7% right now. So you leave your main loan alone at 3-4% that you got it, and just get a HELOC for a second loan and use your equity towards that. Okay. mortgage refers to a second mortgage that is not taken out at the same time as your original loan. That's what the difference between the piggyback and the HELOC and the standalone. So both HELOC, right, meaning piggybacks and standalone, are second mortgages, also known as a second lien on the property. Your original loan, it would be your primary loan, or what we know as first lien, and then your HELOC would be your second loan, or a loan with a second lien, or the second lien on the property. If your original mortgage is completely paid off, you can still take out a home equity loan of line of credit, and it has to be the standalone. Okay, they are used as cash out loans. This is a refinancing only for cash out, not for refinancing interest rate or anything like that. Okay, and they are usually a 20-year term, where the first 10 year is interest only, and the last 10 year is interest rate and principal, to be able to amortize it to a zero balance. So you will see the balance after the 20th year, where it would decrease to a zero balance. Okay, the higher your credit score is what determines how much of your equity you can use. And the max is it's around 90%, is what we see out there on the market, of your equity. Borrowers do not bring funds to the closing, because closing costs is subtracted from the cash to the borrower. Okay, so when you go to get your money cash out, what they do is all costs will be subtracted from the loan, and then you'll get the rest of the money. The minimum is $25,000, and the max is $500,000 on standalone HELOCs. Like any mortgage loan, the income will be verified. Of course, we verify that you can pay the loan, and it has to be within the debt to income ratios guideline. Okay? So there is no prepayment penalties for the HELOCs. So the HELOCs can be paid a month from now, 6 months from now, a year from now. Okay, so it's a good thing. You don't have to wait the 20 years. If you sell your house, then you pay off the both liens. If you were to refinance, we would refinance the whole thing and put into one. So you would only have one loan again. All that can be done. Okay. Properties have to be listed more than 6 months or been in the market more than 6 months, because it would not qualify for less than 6 months for a HELOC standalone. Also, some of the other properties that do not qualify are the condo hotels, manufactured homes, leasehold properties, and commercial properties do not qualify. Okay, so I'm going to leave it at here. I hope this kind of explains a little bit about the HELOC. We've been having a lot of new applications with HELOC now that people are interested in taking advantage of their much bigger or higher equity in their homes. And with interest rates so high, you don't want to refinance your original loan at this moment. So they just take a second one on a HELOC, and with that they can get the money that they were looking for at a lower interest rate than a personal loan, which I've seen in this week in the internet on the web at 26% for a personal loan, almost as much as a credit card. Alrighty. Again, thank you for watching, and I hope this gives you a better understanding of the HELOC and how they can benefit you with all the extra equities that you have now, as property values have gone up so much. I will be posting more content on this subject, as it seems that there is a lot of misinformation still on the HELOC loans. And of course, for any questions, please contact me at my email, or you can also text me at my phone number, 407-720-9237. And again, we are here in Orlando, Florida, beautiful Orlando, Florida, even though it's raining today. Thank you and have a good day.